Yo, what up, what up? Welcome to episode 2 of the Timeframe alignment model series. We're going to be talking about liquidity pools in this one. So let's go back to the syllabus again, right? We had open high low close and open low high close, the power of 3 in the previous episode. Link will be in the description if you haven't watched that one yet. So this one, we're going to be talking about identifying liquidity pools, also known as internal range liquidity and external range liquidity. And these are the two topics we'll be covering in this video. So we're going to be talking about internal range liquidity first, and then we're going to be talking about external range liquidity. But first of all, we're going to keep it as simple as possible because that's where the strength of a trading model lies, right? And if you overcomplicate it, it will be hard to execute your model. So always try to keep your model as simple as possible. Now, as the name states already, right? Everything what's inside of the range, that's what I count as internal range liquidity. Quick summary of the PD array matrix to refresh your mind. It's very important that you know these concepts, right? We have a nice premium and discount area. In that premium area, we have an old high rejection block, bearish order block, fair value gap, liquidity void, bearish breaker, and a bearish mitigation block, and vice versa for the bullish discount levels, right? So you should be aware or at least know what these mean. And we're going to be focusing on the most obvious arrays. My own model, I typically only use fair value gaps and old highs and lows, but in this one, we're going to be covering fair value gaps, order blocks, and breaker blocks. So we got a GBP JPY chart over here. It's completely blank. And first of all, before you want to mark out any PD arrays, you want to be aware in what kind of range you're working with, right? So if I put some lipstick on a little bit over here, right, we have a range high and a range low. Within this range high and range low, this is where we can actually look to mark out our PD arrays. Now, first of all, you need to know on what side of the curve you're on, so you can actually mark out your premium and discount arrays. If you're on sell side of the curve, you can mark out those old highs, bearish order blocks, bearish fair value gaps, bearish breakers, right? And the same thing on buy side of the curve, you can mark out those bullish fair value gaps, bullish order blocks, bullish breaker blocks, and all that good stuff. So be aware where you are on buy side or sell side of the curve, and then you can mark out your PD arrays properly. First of all, we have fair value gaps. It's pretty easy. This is going to be an introduction to just internal and external range liquidity and just how to spot it and what's valid, right? So over here, we've got a fair value gap, right? This is a bearish fair value gap, and we've got another one over here. Now, why is this a solid bearish fair value gap in the PD array matrix? Because it's resting in premium of the range as well, right? If this bearish fair value gap was in discount of this range, you should not use it as an area for sells, right? So really be focused on if you are in premium or discount of the range. Same with order blocks and everything. Make sure you are in premium of the range when you use bearish arrays. So on the buy side of the curve, right, we're from range low and then we're going into buy side of the curve here. We've got those bullish fair value gaps. Now, this is a good one, right, because we're in this smaller range over here and this one is in discount. Same one over here. This is in discount of this last leg up over here. And you can use that as a valid POI for longs, even though we're in premium of the entire range, depending on where you are on the curve, right? Let's talk about order blocks. Order blocks are always connected to the range high of your dealing range. If it's not connected to the range high of your dealing range, this is not a solid order block. And now I will give you a tip on what is a high probability order block. First of all, it needs to take liquidity. Second of all, there has to be SMT on that high or low, which is connected to the order block. And if there is a displacement candle afterwards, makes it even higher probability, right? So if there's a fair value gap formed after this, two up close candles are formed as well. On buy side of the curve, we got also a bullish order block. Why is this a bullish order block? Because it's connected to the range low, right? And the range low took out sell side liquidity down here. That's why this is a good order block. And remember, second, SMT on the lows and displacement afterwards. So this is a solid order block, a displacement, took out liquidity, and there's, I didn't mark it out, but I'm pretty sure there's SMT on the lows here. Now, let's talk about breaker blocks. And I want you to really focus on that a breaker block is not a breaker block if it does not take out liquidity. Same with an order block, it's not high probability if it doesn't take liquidity. And here you can see the last leg high to low. If that block gets broken and traded below, the bodies need to close below, this is considered a bearish breaker because it took liquidity above it, that last leg down where it's connected to, and then it trades below it and closes below it. So this is a valid bearish breaker block. Same for the bullish one, right? Always use the low connected to the high of that breaker block, which is this one. This low got rated down here. So this is a valid bullish breaker block, right? Step one, it takes liquidity on the opposing end of the range. And then second one, it closes above. Let's say this low did not get taken out and it stayed within this range. This is not a breaker block. Rather, it's a mitigation block, but we're not going to talk about that one right now. We're just using the most obvious arrays. So now let's go to external range liquidity, or ERL, as you mostly see on the charts. As the name states, it's liquidity resting outside of the range. We've gone through the most obvious PD arrays within the range, and this one is quite simple because it's always above an old high or below an old low. Now, when we trade from internal range liquidity to external range liquidity, we always want to aim for these three things. We want to aim for the previous weekly high and low. We want to aim for daily highs and lows or previous sessions high and lows. So over here we've got a British pound US dollar GBP USD chart, and I want to focus on that external range liquidity. Where is it resting and where should we focus on trade setups, right? And think about the three things we want to aim for: previous weekly low, previous daily low, and a previous session low. And we're going to outline what that looks like. But first of all, this is external range liquidity. It's all the way outside of the range. You can have the same one up here. It's all the way outside of the range. This is considered external range liquidity. Now, how do we actually look for a setup? Let's focus in on this piece of price action over here, because this is obviously, this is a daily chart. This is a very long time ago, right? This low, but we want to focus on what's closer by so we can actually target our previous daily low, previous session low, or previous weekly lows. So now we're zoomed in a little bit more, still a daily chart. First of all, like we said in the internal range liquidity part, you always want to have your range high to range low, otherwise you cannot mark out your PD arrays. Now, sometimes the range is very tight and it doesn't seem to have any PD arrays on the lower end of it. I consider the PD array matrix a tool to determine where the POIs and mitigation areas are, but a range only needs a high and a low, nothing else. That's a range, so swing high to swing low. So over here, where do we have a PD array? We've got a premium area here and a discount area below it, right? And then we have this bearish order block. This one is attached to the high of the range, and it is higher probability if it takes out liquidity. I don't have a reference point for Euro here, but I'm pretty sure there was SMT here as well. So Euro USD takes out a high and GBP USD does not, makes it a higher probability order block. But we're going to focus on what we're going to target, right? We're targeting that external range liquidity. So if we zoom in a little bit more, 4-hour chart, and we're still focused on that external range liquidity, right? For example, over here, we've got a previous weekly low, which is external range liquidity. And how do we target this, right? If you're talking about a previous weekly low, you want to position yourself on the correct day of the week to frame the high of the week, and then you target the low of the previous week. Price action almost always takes out previous weekly high or low, or previous daily high or low, or a previous session high or low. If we zoom in a little bit more, right? Now we're on the 1-hour chart, and now we can actually look at that previous daily lows. Now, I've marked out a few of them. We've got a previous daily low over here, previous daily low down here, right? And previous daily low down here. Sometimes price does not return to a premium area and just takes out previous daily low, depending on how the candle closes. You will not be always be able to catch those trades, which is totally fine. But if you actually manage to get in on a weekly basis, right, or if you're positioning yourself in the correct day to target that previous weekly low, you can just let it ride out the entire week. If you target previous daily lows, you kind of want to go with the 1 hour and 15 minutes, so you have a more detailed picture of what is happening intraday. And over here, we've got a 15-minute chart. Where are the session highs and lows? Where is that external range liquidity? Because the next session you're trading will almost always take out the previous session's high or low. So this is also external range liquidity. This is more for those scalpers, right? They trade on a 5-minute or a 1-minute targeting London high or New York lows, right? This is valid on a lower time frame. Personally, I always target previous daily high or low, or even previous weekly high or low. For me, that is more of my style. But what does that look like, right? We've got a London low over here and a London high over here. So we actually got a range of external range liquidity above and below on a session. Now the next session, you want to look for a premium level and then target that London low, right? New York session starts, but takes out London low already. Then you have a retracement, and then it drops again, and then we're going to target that previous daily low, right? So if London low is already taken during New York and it starts to retrace, there is still another session, right? There's Asia session, which is just before New York midnight opening, and you can target Asia session low if you know London has set the high of the day. Now, in this context, obviously, we already run buy-side liquidity. Price set high of the day during London, targets all those previous sessions before until it bottoms out over here and starts to consolidate. So I've got a little bit of homework for next week. We're going to be talking about order pairing. Now, what I want you to do is to go to the GBP JPY 15-minute chart on 7th of January and then mark up where those orders get paired up. So buy stops to sell stops, right? Or sell stops to buy stops during New York kill zone. And a little hint, you need to think about smaller ranges within bigger ranges. So think about those external range liquidity within a bigger range. Here's the chart. So make sure to focus on that area over here. If you get it correct and you already know a little bit about order pairing, you are ahead of the curve. But I will see you guys next week. Make sure to subscribe, like, and comment if you enjoy this. And I will see you next week.